they got very far ahead of themselves. I mean, Nvidia is up over $100 a share since those November lows. So, again, a pullback in the markets is not surprising. And this is why we talk a lot about risk management. When markets really overbought, they're extended, take profits, reduce your risk, rebalance your portfolio, don't speculate, don't use leverage. And whenever you have those correlations, do that. That's not, people try to apply narratives and say, well, this asset's doing this because of this reason, and this asset's doing it because of that reason. That's just rationalization to try to justify why all the prices are rising together. But when that occurs, that's the perfect setup for the market to have a correction.
What you want to watch for is the moment where Nvidia, the darling stock of this sector, delivers yet again just better than fantastic results, and yet it's not enough to power the party higher. And that's you can say that's what we saw yesterday.
And that's why we always go back to the technicals and say, what's the market saying? It doesn't matter
Right.
what my opinion here is with you. I can spout stuff all day long with you. It doesn't matter. What's the market saying? And so that's why when we get down to portfolio management and we talk about that, it's always back to, managing risk, managing exposure, those type of things, because we're paying attention to what the market's telling us that it's doing. And whether or not we agree with it is irrelevant. It's what the market's doing that's important.
According to veteran portfolio manager Lance Roberts, the market is flashing its most serious warning signs in months. The recent sharp reversal, especially on a day when Nvidia reported blockbuster earnings, is a major red flag. Roberts points out that the technical picture is now deteriorating, with key moving averages like the 50-day and 20-day starting to roll over. But here is Lance Roberts' critical warning. The line in the sand is the 100-day moving average. He states plainly that if the market bounces, fails, and then breaks below that level, and I quote, "We got problems." That is the signal for his firm to aggressively cut exposure and get defensive. This isn't just about charts, Roberts explains. He reveals a massive economic illusion. The booming spending on AI is masking a severe underlying weakness in the broader economy. This sets up what he calls a big concern for 2025, where Wall Street's sky-high earnings expectations for small and mid-cap companies are completely detached from the reality of a slowing consumer. But the biggest threat, according to Lance Roberts, is hidden in the shadows. He issues a stark warning about the private credit market, calling it a ticking time bomb. He specifically names the buy now, pay later sector as something he believes is going to blow up. Roberts' final conclusion is that this will lead to a K-shaped bifurcation, where a small segment thrives while the majority is left behind. His solution? Don't follow the hype. His disciplined, risk-managed portfolios are weathering this storm with far less damage than the market. In a volatile time, Lance Roberts' message is clear. Stop listening to narratives and start listening to what the market is actually telling you. It's time to get defensive. Subscribe to Fine Metals for best financial advices and latest news.
You're likely going to get a bounce, but if we bounce to 6,700-ish, which is the 50-day fail there, and then come down and take out the 100-day, we got problems. And that's where we're going to be cutting it. If that happens, that's where we're going to cut a lot of exposure. See the 50-day flatten out. We're starting to see the 20-day moving average turn down. That's not a great sign. That doesn't, we've seen these wiggles before, and then they correct themselves, market takes off running again, everything's fine. But if we begin to see this kind of price action begin to flatten out or deteriorate, I'm going to become a little bit more concerned about the amount of exposure we have in our portfolio and begin to kind of start looking to reduce. But again, I'm not going to do that here because markets are decently oversold. I'm going to look to reduce exposure on a bounce and rebalance. Prices have been trending higher. That's good. But moving averages act like gravity, and you're eventually going to have that gravitational pull is going to pull prices back to that average or below it. And that's when we talk about mean reverting events. What's a mean reversion? A mean is the average, and reversion is basically prices are reverting back to that average. That either means from above it to it or below it, or from below it back above it. To your point, when I get really deviated above that moving average, your odds are much higher you're going to get a reversion in April because of the whole tariff issue. We don't have the tariff issue right now hanging over the head. There's no big kind of catalyst to drive a major downturn. So that's why we're not as concerned as we were then. But it's still important to pay attention to. Now, the markets had this really big run right here in late October, going into early November. So the markets got really overbought on a short-term basis, pushed up in overbought territory, but you just had this really big sharp advance kind of out of nowhere. And markets got very deviated above their means. And this is what we started talking about a few weeks ago. You and I were saying, hey, markets are very deviated here, take some profits, kind of rebalance risk, those type of things, because we're probably going to get some type of consolidation or a pullback. And that's what's happened here. And so we're currently sitting on now the important thing was is we broke through the 50-day moving average. That's this blue line. So we were above the 50-day moving average for, don't quote me on the number, but I think it was 139 days. It was like one of the longest stretches above the 50-day moving average we've had in quite some time.
Yeah, I mean, pretty much since the end of April, it looks like.
Yeah, yeah. But I mean, I'm talking about the length of the
No,
stretch.
no, I know. Yeah.
Yeah, it was just a very long run. And there's nothing wrong with that because all a moving average is it just tells you what the average price was over the last 50 days. But what is unusual is that when it stays above that 50-day moving average for a very extended period of time, because an average means the price of the market was both above and below that average over the last 50 days. That was kind of the point of my article today, talking about how this AI data center spending, which is boosting economic activity, it's also masking over a lot of the other economic weakness that we see going on across the board. Because again, if I build out a data center, I'm hiring construction workers, I'm hiring electricians, I'm hiring trade skills, right, to build those data centers. But that doesn't necessarily translate all the way over through, people owning restaurants and people working in office jobs and those type of things. And so if you take a look at the broad swath of the economy, there's a lot, the economic strength is not as robust. Again, take a look at the Atlanta Fed GDP now as an example. They're at 4.2% real growth for the third quarter. That if you take a look at a lot of the other economic data, it doesn't suggest that we're not seeing booming economic growth across the broad spectrum of the economy because you've got auto delinquencies rising, you've got default rates, mortgage delinquencies that are rising. You're seeing a lot of pressure on a big bulk of the economy that's not being really fairly represented by what's going on with just construction. Earnings expectations next year are exceedingly high. We're going to, FactSet's predicting like $320 a share by the end of next year for the S&P 500. But if you take a look at the breakdown, they're saying, well, the big cap tech companies, their earnings growth, you're talking about Nvidia, Microsoft, Tesla, those guys, their earnings growth is going to slow down. But the Russell 2000, the small and mid cap companies, their earnings are going to explode next year, right? They're going to be up 60%, 59% next year. This massive, earnings growth for the S&P 500.
What's the potential, or in your gut, what's the potential of private credit to potentially spark a counterparty risk freeze?
I don't know if there's, because counterparties are between banks and private credit is kind of sitting outside of that.
Sorry,
There may
sorry to
not be.
interrupt, but just in your answer, address this. I've heard that, hey, actually, banks do lend to the private credit
They
industry, so
do.
they're not like totally separate.
Right. No, no, I was about to say is that there
Okay.
is leverage that's going on that the banks provide.
Yeah.
So again, this is the whole reserve, issue that we've talked about recently about how the Fed creates reserves for the banks. The banks then loan that money to hedge funds, private credit funds, et cetera. So, that money gets created, money gets created through loans and it gets created out of those reserves. So absolutely there's leverage from the banks provided to these private credit funds. So yeah, there's certainly risk.
If I were to bet on, one of the areas of private credit that I think is going to blow up at some point, I'm putting my money on buy now, pay later.
So the outcome of this is not good. And again, what we're going to wind up with in society is a very bifurcated society. People need purpose. If I don't have a reason to get up in the morning, there's no reason to get up in the morning. So our portfolio is down about 1.5% versus the market 3.5%. So, really not a lot to do. We carried a really good balanced portfolio up to this point. If I'm just building the data center building and I'm charging rent for it, Once it's filled up, it's filled up. My rent stabilizes except for inflation, right?
Right.
So
Well, and there's 1,000 companies that can compete in that space too.
exactly. And then there's going to be a lot of companies that provide AI software, right? And so, I'm a company that provides AI agents for, agentic, kind of uses. But then somebody else comes along with better AI agents, and then my business is out of business because nobody used them anymore. So, there's going to be company, and again, we saw this in the dot-com era. There are going to be companies that survive. And there are going to be companies that profit enormously from what's going to happen with AI. There's going to be a lot of companies that go away. The Core Weaves, the Applieds, a lot of these other ones, maybe they survive. Maybe they're the winners. Maybe they're not. There's other openings in there for those companies to get displaced by somebody else that can do the job better, cheaper, faster, whatever, or just differently than what they do. And that's where everybody tends to go. Paperwork snafu, or you forget to sign a dotted line somewhere. Those things happen. Give yourself some time. If you've got if you're, over the age of 72 and you need to do your RMDs, I would start working on that now if you haven't done it. Doing your tax loss harvesting, your charitable giving. If you need to set up things like a donor advised fund, those type of things, those can be done. They can be very tax efficient. They can be very friendly for you tax wise, but it takes time to set up. So again, give yourself a little bit of time. Start thinking about that now. If you don't know what a donor advised fund, or if you don't know how to do charitable giving, those type of things, and the most tax, because you can donate. You don't have to sell stock and go donate cash. You can actually give stock as part of your charitable donation for the year, but give yourself some time to do it. Don't wait till the last minute so that you get behind behind the deadline. But again, we don't have, like, I can't go to, if I want to know how much treasury debt's outstanding or corporate debt, I've got a data feed for that.
Yeah, but this is the problem with the private credit market is it's unregulated. We don't have this
That's
is
my point.
transparency. Yeah.
Yeah, exactly. And that's kind of my point. So it's
Yeah.
a
I
little
was
bit.
just saying it's bigger than just a couple billion.
Yeah,
We
yeah.
know that.
We do know that. Yes, this is true. But my point is that what I think we are seeing, though, is again, you take a look at some of these companies that are in that space, they're under a lot of pressure because the consumer is slowing down. This goes back to what I was saying earlier, is like, you look at the bottom of the economy, that bottom 50, 60, 70% of the economy, they're not doing great. The top 20% of income earners are floating 50% of consumer spending right now. Examples yesterday, Nvidia was down 2% at the end of the day. Walmart was up like 4.5. So, that we have these different positions in the portfolio that tend to offset each other. So if I have a bad day in one position, I've got another offsetting position. We talked a couple of months ago about healthcare being very out of favor, and that we were adding the healthcare stocks. Those have been doing very, very well and have helped really kind of balance the portfolio. So this week we haven't had to do anything. But again, over the next couple of weeks, we're going to be doing tax loss selling, rebalancing the portfolio for the kind of the end of the year, and just kind of doing some maintenance and cleanup. So, kind of looking for a bounce here in the markets that might last 2, 3 days. And then maybe next week we'll start doing some of that work. It is absolutely going to be the case. I just interviewed Peter Atwater. We've got his interview. We're going to run his interview next week. I just interviewed him talking about the K-shaped economy. But this is going to be a K with a very long lower limb going out of it, and it's not going to be good. And eventually, I think people have to rebel to some point. And, I think a really good picture of the future is, if you've never seen the movie Ready Player One, you should watch the movie. I think it is a really good prediction about where we wind up in the future based on what we're doing today.